Receivables and payables are fundamental components of working capital management and represent amounts owed to and by an entity arising from credit transactions. Under the accrual basis of accounting, these balances are recognized when goods or services are supplied or received rather than when cash is exchanged. Proper accounting for receivables and payables ensures that financial statements present a faithful representation of an entity's liquidity, financial position, and credit risk exposure. The program emphasizes recognition, impairment of receivables, allowances for expected credit losses, contra arrangements, and supplier statement reconciliations as essential accounting procedures. 1. Receivables and payables. Trade receivables. Trade receivables represent amounts owed by customers following credit sales of goods or services. Examples include credit sales invoices, outstanding interest receivable, rent receivable, other amounts due from customers. Receivables are classified as current assets because they are normally expected to be collected within one operating cycle. Trade payables. Trade payables represent obligations to suppliers arising from credit purchases. Examples include supplier invoices, outstanding accrued expenses, trade creditors, amounts payable for services received. Trade payables are classified as current liabilities because settlement is normally expected within 12 months. 2. Benefits and costs of offering credit facilities. Offering credit to customers may significantly influence sales performance and competitiveness. Benefits: increased sales revenue, improved customer relationships, enhanced competitive advantage, greater customer loyalty, attraction of larger commercial clients. Costs and risks: delayed cash receipts, increased financing requirements, administrative collection costs, risk of bad debts, opportunity cost of tied-up working capital. Management must balance higher sales opportunities against increased credit risk and liquidity pressures. 3. Aged receivables analysis. An aged receivables analysis classifies outstanding customer balances according to the length of time they remain unpaid. Typical categories include current 30 days overdue, 60 days overdue, 90 days overdue, over 120 days overdue. The analysis assists management in monitoring collection performance, identifying overdue accounts, assessing credit risk, estimating expected irrecoverable debts, improving cash flow management. Older balances generally carry a higher probability of non-payment. 4. Customer credit limits. A credit limit represents the maximum amount of credit that management is willing to extend to an individual customer. Credit limits help control exposure to bad debts, reduce credit risk concentration, improve receivables management, encourage timely payment, strengthen internal credit controls. Exceeding approved credit limits may require management authorization before further sales are made. 5. Irrecoverable debts, bad debts. An irrecoverable debt arises when management concludes that a customer will not pay an outstanding balance. Examples include bankruptcy or prolonged inability to recover amounts owed. The debt must be removed from receivables and recognized as an expense. Journal entry: Dr. Irrecoverable debt expense. CR trade receivables. This entry reduces both receivables and current period profit. 6. Recovery of an irrecoverable debt previously written off. Occasionally, customers subsequently repay debts that were previously written off. The accounting treatment is reinstate the receivable. Dr. Trade receivables. CR irrecoverable debt recovered. Then record receipt. Dr. Cash. CR trade receivables. Alternatively, entities may credit the recovery directly to profit or loss as income. Such recoveries increase current period profit. 7. Impact of irrecoverable debts on financial statements. Statement of profit or loss. Irrecoverable debt expense is recognized as an operating expense, reducing profit for the accounting period. Statement of financial position. Trade receivables decrease by the amount written off, reducing current assets and net assets. Thus, bad debt recognition ensures that receivables are not overstated. 8. Allowance for irrecoverable debts. Because some customers may default in future, entities estimate an allowance for irrecoverable debts, also called allowance for doubtful debts or expected credit losses. The allowance reduces receivables to their expected recoverable amount, creating an allowance. Dr. Irrecoverable debt expense. CR allowance for receivables. Increasing the allowance. If the required allowance exceeds the existing balance. Dr. Irrecoverable debt expense. CR allowance for receivables. Reducing the allowance. If the required allowance decreases. Dr. Allowance for receivables. CR irrecoverable debt expense. Only the movement in the allowance affects annual profit. 9. Presentation in financial statements. Statement of profit or loss. The following are recognized. Irrecoverable debts written off. Increase or decrease in allowance for receivables. The net movement affects operating expenses. Statement of financial position. Trade receivables are presented as. This reflects the amount expected to be collected. 10. Contra between trade receivables and trade payables. Where the same entity is both a customer and supplier, reciprocal balances may be offset by agreement through a contra arrangement. Example. Receivable equals $8,000. Payable equals $5,000. Net receivable equals $3,000. Journal entry. Dr. Trade Payables. CR Trade Receivables. This simplifies settlement while reducing payment transactions. 11. Supplier statements and reconciliation. A supplier statement summarizes all invoices, payments, credit notes, and outstanding balances during a reporting period. Reconciliation compares. Supplier statement balance purchase ledger account balance. Differences may arise from timing differences, missing invoices, unrecorded payments, credit notes, posting errors. Supplier reconciliation strengthen internal controls, improve accuracy of payables, detect errors promptly, and support effective cash management. Accounting for receivables and payables ensures that credit transactions are recognized accurately and measured prudently in accordance with the accrual basis of accounting. Proper management of credit policies, aged receivables analysis, irrecoverable debts, allowance for expected credit losses, contra arrangements, and supplier reconciliations enhances liquidity management and strengthens the reliability of financial reporting.